Hi, I'm Richard Ryan with the Ryan Mortgage Team here in Atlanta, Georgia, and I'm going to talk to you briefly about how to eliminate the monthly MIP on your FHA mortgage. It's a question we're asked often, and there's not a lot of good content out there about that, so I decided to shoot this video. We'll launch right into the presentation here. There's some contact information for me. So first, let's do a little background. What is MIP? There are two types of mortgage insurance on FHA loans, the upfront and the monthly. Unless you're getting a 15-year loan and putting down 22% or more, then you're going to pay both the upfront and the monthly MIP. Now, at the end of 5 years, if your loan to value is 78% or less, the MIP should automatically be removed by the lender, though you will want to double check with them to make sure that happens at the 78% level. This chart gives you a quick breakdown of the current MIP rates for the monthly. Feel free to pause the video if you need to take a look at that chart. It's also below in the text. But if we look at this, for most people, they're going to do a 30-year fixed loan, so loans greater than 15 years. And they're going to do 96.5 is typically what you're going to do with a 3.5% down payment. So on the new MIPs here, 115 basis points per year. That's 1.15% of the loan amount. Let's just take a quick example and see how the MIP plays in. In our example here, you're purchasing a home for $200,000 with 3.5% down, which is $7,000 down. You take out a 30-year loan and roll in your upfront MIP of $1,930 into the loan. That makes your total loan amount here $194,930. So your monthly MIP using the chart is 1.15%. The 1.15% is the annual amount that you pay, so we'll divide that by 12 and end up with $186.81 per month in mortgage insurance paid. Again, this amount gets paid to HUD to keep the FHA loan program working. Now let's talk about eliminating this. These two requirements that you see here, 5 years must pass, you must pay it down to 78% loan to value, they must be met, with the only exception to that being if you do a 15-year fixed, and we'll talk about that case a little bit later. But if you have anything other than a 15-year fixed, first you must wait for the 5 years to get rid of the MIP, regardless of how much you put down initially. So it really doesn't matter what your loan to value is. If 5 years haven't passed, you're going to keep paying that MIP to FHA. Second, you must pay the loan down to 78% loan to value based on the value of the home when the loan was taken out. So if it was a purchase loan, you'd use the purchase price to determine the loan to value. Or if you refinance the FHA loan, then you'd use the appraised value at the time you took out the FHA loan. Unlike a conventional loan, you cannot get a new appraisal to remove the monthly MIP. One advantage of the FHA MIP program over the conventional mortgage insurance is that the lender cannot force you to prove that the home has not declined in value when you are attempting to remove the MIP by paying down the loan balance. And that is happening to a lot of people on their conventional loans today. Alright, so what's the trick to eliminating the MIP? We'll walk you through exactly how to determine your new payment to eliminate your MIP at the end of month 60, which again is the earliest you can eliminate it. The trick is to pay an equal extra amount each month that will take your principal balance down to 78%. Now, if you follow the link that's below this video to our calculator, you can calculate for your particular situation. But what we'll do here is we'll go through our sample calculation and show you exactly how that works on the website. Going back to our original example, say you purchased a $200,000 home with 3.5% or $7,000 down, and you took out a 30-year loan at a rate of 4%. Your upfront MIP was $1,930, and you rolled that into the loan, giving you an initial loan balance of $194,930. Your monthly MIP is $186.81. Using our calculator, we see that our required principal and interest payment is $930.63, and we need an additional $288.09 paid each month to bring our balance down to 78% at the end of year 5. Now let's take a look at that and how that works. Here is the calculator. And we've got the initial loan balance here, $194,930, 30-year fixed loan, 4% rate, and we put in the 96.5, which was our original loan to value. Assume we're taking the loan out now, which is January 2012, and calculating that, we get the current principal and interest is $930.63, which matches that. And the new payment would be $1,218.71. That's going to take our loan balance down to $157,560 right at the end of 5 years. And so those numbers match over here. If we follow that plan instead of making the normal monthly payment, on average it's going to eliminate 10 years worth of the monthly MIP payment. So for this example, that would save you $22,417 over those years 6 through 15. That's nothing to sneeze at on a $200,000 home purchase. If we carry that example out just a little bit further, you, at the end of year 5, and you've paid your loan down to 78%, you're already used to that higher payment. So let's just say that you continued then to pay the additional principal of $288.09 per month. If you did that throughout the remainder of the loan, it would pay off in 19 years, saving you 11 years of interest on that loan. And then if we took it even further, you are used to the payment, you're used to the payment plus the MIP. Well, now your MIP's eliminated at the end of year 5. Let's say you continue making the additional $288.09 payment, and then you're going to add in what you were paying towards the MIP of $188.09 and add that to your additional principal payments. Then your loan's going to pay off another 4 years early, so you're going to end up with a 15-year loan instead of a 30-year loan. So some pretty significant savings there. As with most things in life, there are exceptions to this. So if you have an FHA loan on a condominium, then that is not going to apply. And also, if you took out a 203K renovation loan, those don't apply either. For whatever reason, HUD has determined that those are not considered MMI loans, and they require you on those to keep the MIP for the life of the loan. So on the 203K renovation loan, just a little trick there, your goal would be to, once you get the renovations complete, go ahead and do a streamline refinance out of that loan, and then you should be able to remove your MIP. Finally, we talked briefly about, we touched on the 15-year fixed. That one is actually better than any of the other cases because the HUD does not make you wait for the 5 years. So you only need to pay down the principal to 78%, and you can remove the MIP. And it's the low rates we have today, you're actually going to pay down to 78% in just over 2 years. So that's quick tips on how to get rid of your monthly MIP. Feel free to give me a call with any questions.